You ever open your banking app and hold your breath like you're about to check exam results you didn't study for? It's Friday. You got paid. For about 6 hours, you feel financially responsible, mature, stable. By Sunday, your account looks like it survived a natural disaster. Rent, car payment, just one thing from Amazon. 3 subscriptions you forgot about, and $62 in food delivery because you were too tired to cook. Now you're staring at $147.83 like, wait, I make decent money. Why does my bank account act like I don't? Yeah, that's not bad luck. That's the system working exactly as designed. My name is Aaron, and I spend way too much time thinking about how banks actually work and why most people completely misunderstand them. If you're someone who works hard but still feels slightly confused about where your money disappears to every month, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Because today we're talking about banks. Not the friendly, we're here for your financial journey version, the real one. The misconception. Most people think banks are giant vaults. You deposit $1,000. It sits there, safe, protected, waiting patiently like a loyal golden retriever. Look, that's not how this works. Banks don't store your money. They deploy it. Here's what most people don't realize. When you deposit $1,000, the bank keeps a fraction, let's say 10%. They keep $100. They lend out $900. That $900 gets redeposited somewhere else. That bank keeps 10%, lends out $810, then $729, then $656. And it keeps multiplying. This is fractional reserve banking. According to the Federal Reserve, this process is how new money expands throughout the economy. Now here's the fun part. Your savings account might pay you 0.5%. Meanwhile, auto loans, 7%, mortgages, 7 to 8%, credit cards, 20% plus, you get 0.5%. They get 20%. That's not a coincidence. That's a business model. You're earning gum money. They're earning yacht fuel. So, the pisswitchology, now be honest. When your paycheck hits, do you feel temporarily rich? Like you could suddenly start fresh? That's dopamine, not wealth. Banks understand human behavior better than most therapists. They know we want convenience, we want speed, we hate friction, so they remove friction. Tap, swipe, click. No physical cash leaving your hand. Behavioral research shows people spend significantly more using cards versus cash. Why? Because it doesn't feel real. Your brain treats digital money like points in a video game, until the bill shows up. And suddenly the video game has consequences. The seer. Legend, say you carry a $5,000 balance on a credit card at 20% APR. If you make minimum payments, you could pay over $2,000 in interest on money you already spent, on things you probably don't even remember buying. That quick weekend trip, emotionally priceless. Financially, a small personal recession. Now you might be thinking, okay, but I need credit. I need banks. Correct. Banks aren't villains. They're optimized. There's a difference. They don't need you bankrupt. They just need you slightly behind, consistently. Here's the wake-up moment. According to Federal Reserve data, Americans carry over $1 trillion in credit card debt collectively. At 20% interest, money doubles roughly every 3-4 years. If that's working for you, incredible. If that's working against you, you are compounding stress. You are financing executive bonuses. You are literally paying interest on takeout. Pause for a second. If someone offered you a guaranteed 20% return, you'd think it was a scam. But people pay 20% every day without questioning it. That should bother you, calmly, but deeply. Eclipsing the system. Now let's flip it. Instead of paying 20%, you invest $5,000 at 7%. In 10 years, about $9,800. In 20 years, roughly $19,000. Same math, different direction. Interest is neutral. It doesn't care. It either works for you, or it invoices you. This is where it gets really interesting. Banks don't actually rely on the wealthy. Wealthy people borrow strategically and invest. Banks rely on normal earners who keep money sitting idle, carry small revolving balances, finance depreciating assets, confuse lifestyle with progress. Modern banking profits from behavioral drift, not financial illiteracy, just mild, socially acceptable overspending. That's it. Practical steeps. So what do? Keep emergency savings in the bank. 3-6 months of expenses. Never carry credit card balances. If you can't pay it off this month, it's not affordable. Automate investing. Let compounding work quietly. Track your net worth monthly, not just your bank balance. Add friction to spending. Remove saved cards. Wait 24 hours before non-essential purchases. Small discipline. Massive long-term separation. Sisson. Shift the mindset. Look, banks are tools, but most people treat them like financial parents. They're not supervising your future. They're monetizing your behavior. If your money is sitting still, it's being outworked. If your debt is growing, it's being applauded somewhere. That's not dramatic. That's math. Here's the takeaway. The goal isn't to avoid banks. The goal is to understand them. Use them for storage. Use them for leverage when necessary. But don't unknowingly fund the system that keeps you financially stagnant. Because the real shift happens when you stop thinking like a customer and start thinking like the institution. So next time your paycheck hits and you feel rich for 12 hours, ask yourself, is my money working or am I? And which one is working harder? You wear it Impact Wealth School, where money makes sense.